All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. We got a big update here. We got a new high, 52-week high in the S&P 500. So we're ending the year ending the first half of the year with a little bit of a bang here.
Yeah, it's hard to believe the first half is already coming to an end, but we're going to get into everything. So first up, Bob, how is the market performing so far this year as we come up to the end of the first half?
Well, it's been gangbusters. I mean, the main index I watch is the S&P 500 because it's the broadest measure of the U.S. stock market. It's the 500 largest stocks, and that the S&P 500 is about 80% of the market value of the entire U.S. stock market. It's up 15%, which is a gangbusters performance. Remember, we were down 20% last year. NASDAQ is doing even better because a lot of the mega cap tech stocks are there. That's up 30%. And smaller stocks are sort of lagging. The Russell 2000, which is a measure of small cap stocks, is only up 7%. And that's primarily because there's a lot of the small banks, like community banks, in your neighborhood, there's like little tiny banks. They're tiny. They're publicly traded, but they're tiny. And they've had a rough year because of what happened in the banking crisis in March. So by and large, though, if you own the broad market, you're going to be very happy. If you own an S&P 500 index fund, you're going to be very happy this year. Tech's been the big leaders. We were talking about Apple, new high today, semiconductor stocks. We talk about that. But consumer discretionary stocks are doing well. What's that? Housing stocks are really doing well. Oil stocks, travel, the cruise lines are new highs right now because everybody's traveling like crazy. I'm sure anybody who's gone out on a vacation, gone on an airplane, got on a boat, sat in a restaurant, prices are high, and yet they're getting them, at least right now. What we're not seeing is a sort of broadening of the market. When you're in an up market, you don't want it to be in just individual sectors. Signs of strength are broadening of the market. So you want to look at the advanced decline line. How many stocks are advancing versus declining on a daily basis? That's a sign of really broad strength. And it's been kind of it's all right, not great. We have several sectors that are just lagging. So, for example, defensive names like consumer staples stocks, your Procter and Gamble's and Coca-Cola's of the world. They've been lagging. They're kind of flat. Healthcare has been lagging. They're kind of flattish to down slightly on the year. And what we call cyclicals that are sort of economically dependent. Energy hasn't been doing. Metal stocks, mining stocks haven't been doing that great. Some industrials are doing well. General Electric's at a new high, and that's a good sign. But the bottom line is you really want to look at how broad the market advance has been. You don't want just a few stocks. And it's been That's the one little thing the bulls don't really have. Other than that, Katie, if you want to look back on the year, it's amazing how wrong the consensus has been. When we started this year, everyone was expecting this gigantic recession to start, and earnings were going to be down 10%, and the S&P was going to be flat on the year, and none of this has happened. The U.S. economy has been much more resilient than people thought. The job market remains very strong. Corporate earnings remain strong. As of right now, we're basically going to have a flat year. And there were a lot of people anticipating 10 to 20% decline in earnings. And earnings are what kind of determines the directions of the stock market. So it hasn't happened. Inflation is still high, but it's getting under control. We had an inflation report today that was excellent. The reason the market's up is because the inflation numbers are lower than expected. So the Fed is trying to keep inflation down. They want to get it down to a target of 2%. It's more than twice that, but it's moving in the right direction. So bottom line is the consensus was wrong. By the way, this happens a lot. If anybody, we have talked about this before, and I wrote, I have a book out, Shut Up and Keep Talking, and there's several chapters in it how wrong forecasting has been, economic forecasting of all stripes. Individual investors, professional investors. The Federal Reserve has a terrible track record of predicting the U.S. economy. Everybody does. And there's some reasons why it's very difficult to forecast the future. But it's always fun when the consensus is generally wrong. So who knows what's going to happen in the second half? We can talk about it if you want. But so far, the consensus that we had in January has been wrong, that we're not in some imminent recession.
So Bob, let's get into one company in particular. You mentioned Apple. Apple's market cap just hit $3 trillion. So how big is $3 trillion for a company? What does that mean?
You know, part of the problem is we all struggle as journalists to convey how big $1 trillion is. It's a lot of money. When this happened a few years ago and Apple hit $1 trillion, there was all sorts of funny little things out, like if you stack a stack of $1,000 bills, you have a $1,000 bill and you have a stack of them, how high would $1 trillion be in $1,000? It'd be about 67 miles high. Believe it. Now think about this. So this is kind of like stupid comparisons, but how do you convey how big $1 trillion is? It's really a lot of money. Apple's now $3 trillion. It's the highest valued company in the United States. And we've started taking, and other strategists have started taking the other measures and saying, oh, it's 67 miles high with $1,000 bills. And one way to look at it is Apple is about the size of the GDP of France. So you start, I know this sounds kind of silly, like the gross domestic product, the total value of the output of France is about 2.9 trillion. Apple's 3 trillion. It's about the GDP of France. Now, that is not an apples to apples comparison. It's not exactly the same thing. It's, you know, market capitalization is not GDP, but it gives you a sense of the scale of what we're talking about. And some of these other companies are the same way, like Microsoft, $2.5 trillion market cap. The market cap of Italy is the GDP of Italy is 2.1 trillion. Now you can go on and on with some of these companies. Alphabet, you know, Google, 1.7 trillion. That's about the GDP of Mexico. You can go on and on with these comparisons. And I know some people think they're silly, but again, the purpose is to give you a sense of how big is $3 trillion. And when I say it's about the size of the GDP of France, I mean, that's a fair way of giving you a sense of the scale, even if it's not exactly an apples to apple comparison. So big, really big. 3 trillion is a lot of money.
Yeah, thank you for putting that into context there. I think that's really helpful for everyone. So Bob, you know, we mentioned this is the end of the first half. What are you watching as we get into the second half of the year?
Well, you know, remember, so everybody who thought we were going to have this imminent recession has been wrong, right? But that doesn't mean we won't have one or that we couldn't have a mild one. Here's the way I look at this. You try to just turn this whole thing upside down. So we're up 15% in the year. What would it take to go to zero? Look, we're going to get some kind of summer correction because it statistically always happens. So nobody should be shocked if the S&P drops 5% from here, 7 or 8% sometime over the summer. That would be statistically normal. We'll make a big deal about it, by the way, because, you know, we're here on a daily basis. But it would be statistically normal. I'm thinking, like, what would it take to go back to zero for the year? We're up 15%. What would have to happen? And it would have to be pretty bad news. So you'd have to believe the soft landing everybody wants to believe isn't going to happen. You'd have to believe somehow there's going to be some big drop in the jobs market. Not just a little, but a significant drop. You'd have to believe that earnings are going to sort of drop big, 10, 15%. That's a lot. You'd have to believe that interest rates are going to move a lot higher. Now, remember, Powell has been saying that they might have 2 more rate hikes of 25 basis points. That's 0.5%, 50 basis points, 0.5%. I'm not talking about that. I mean, much more aggressive even. I don't know. Those things could happen, but think about it. That's a pretty extreme thing. Remember, I'm not talking about a little, you know, drop of 5%. I'm talking like would have to go 15% or more to go negative for the year. That's a big order right now. And by the way, historically, when you have really strong second halves, you tend to hold up very well. When you have really strong first halves, you tend to hold up in the second half. So since in the last 43 or so years, there has been 10 times when the S&P is up 15%, which is what we have in the first half. Okay. 10 times this has happened in the last 40 years. And all 10 out of 10, it's been up by the end of the year. There's never been a situation where it's gone to zero by the end of the year. The average gain is 23%. In those 10 years, when the S&P is up 15% or more in the first half, the average is it's up 23%. That means it usually gains it gains some more in the second half. It doesn't drop on average. Now, again, could it be down? Yeah, but statistically and historically, the odds are arguing against it. And that's why the bears are really on the defensive right now. People are upping their targets instead of, standing firmly and insisting somehow we're going to have some massive imminent recession. And again, there's different kinds of recessions out there. It could be a very gentle one. Most of the camp, the consensus is in the mild recession camp. That's the soft landing. The soft landing is jobs slow down, interest rates rise a little bit more, but not too much. Earnings are relatively stable to down slightly. That's really the soft landing. And so far, that's what we've been getting.
So, Bob, as we look out for the second half of the year, will we see more IPOs this year?
Oh, I've had a great week. This was my bread and butter for 20 years on the floor, dealing with new IPOs coming on the floor. And we had some great ones this week. We had Savers Value Village, which was really a lot of fun. I didn't know a lot about this company a few weeks ago, but this is the largest. It went yesterday public at the NYSE. This is the largest for-profit thrift operator in the United States. There's a lot of nonprofits, but this is the largest for-profit. And it's a very interesting company. They kind of tick off a lot of boxes for investors. Number one, they're profitable. Number two, thrift is kind of cool right now. There's always been a traditional thrift shopper, but the Gen X kids love it. Obviously, it goes under the name vintage, but they like it. There's also an AI angle or a data angle here because they have very good data analytics. So they can look at these clothes and say, aha, here's this Louis Vuitton buried in here, this jewel, and they know how to price it appropriately. It's a database thing. And that really improves profitability. There's an ecological angle to this too. People get shamed in saying, look how much food we throw away in this country. And it's true, it's terrible how much food we throw away. But we do the same thing with clothing. We throw enormous amounts of clothing in landfills, and it's stupid. And their S1, their report on going public, detailed the millions and millions of pounds of clothing that are thrown into landfills stupidly and wastefully, and they're right. So there's a sort of ecological angle about reusing clothes. And finally, there's a little bit of a recession angle. So thrift is traditionally kind of recession-proof. But if we go into some kind of recession, even mild, thrift would benefit from that. So you see all these little boxes this company ticks off. Profitable, its thrift is cool, there's a tech angle, there's an ecological angle, there's a recession angle. And so the company priced above the range and really did well yesterday. The question is how the second half looks. Is the overall IPO market opening up? And the two things that matter, the things that matter is, number one, you have a strong stock market. And I would say the stock market's pretty strong. And number two, the interest rates are steady. And you don't want them going up too much because that's generally bad for IPOs. I would say they're steady right now, but they're on the verge of being toppy right now. So the question now is, what happens to some of these big companies? We've had these companies like Reddit, Instacart, Panera Bread, and other names that are sitting out there, other potential candidates, Impossible Foods, Fanatic, StubHub, ARM, the big semiconductor manufacturer that's out there. And I don't know. It's a little different when you talk about modestly larger companies that are niche players like Savers Value Village versus bigger companies. I'd say that the market is definitely opening up, but I wouldn't say it's a bull market in IPOs right now. I think the one piece of good news is there might be some more IPOs in July. Traditionally, July and August is kind of Deadsville for IPOs. If it doesn't get done by July 4th, often it just waits until Labor Day. We may see some companies go public. There's a couple of companies that are out there that I think have a potential to go public in July. There's a big cosmetics company that might come, and I'll keep an eye on this. But I'm optimistic. The fact that we had 3 companies going this week that were pretty big, Kodiak in the gas business, Fidelis in insurance, and the Savers Value Village, that kind of makes me somewhat optimistic. I think the big tech people like Reddit, they still have to evaluate. The problem here is if you don't go public now, when would you? What kind of conditions are you going to wait for? It could be years again. So I know this can be a tough call for a really big company, but heck, a lot of the conditions are pretty good right now.
Yeah, we'll definitely keep an eye on that as we go forward this year. So Bob, let's talk about chip stocks. How are the chip stocks doing, and Nvidia in particular? How are things doing?
Oh, well, you know, Nvidia, it's a best performer up there. What's it, up 180% so far in 6 months. The semiconductor, and the one I watch is SMH. That's an equal weight index of the big semiconductors, and they're up 40% or so. And this is all an AI play. So remember the old phrase in the gold rush in the 1840s. It wasn't the gold miners that got rich. It was the people that supplied them with the picks and shovels that got rich. Levi Strauss, blue jeans came out of that. They wanted to make a pair of pants that were durable and they had that could hold up. And Levi Strauss got rich selling pants. And the people who sold picks and shovel got rich. The gold miners didn't necessarily get rich. So the picks and shovel in this situation are the semiconductor companies. They are the picks and shovels of this whole AI game, because without it, you don't have it. So Nvidia has been the immediate winner, but so is almost all the other chip makers. The problem is, how long is this game going to go? People think that AI is, the same thing that happened to select companies in the internet in the 1990s. I tend to think they're right, but it's hard to pick winners on this game. This is why indexing is very, you don't have to pick any winners if you own the S&P 500. The fact that the largest tech names are up so much has itself pushed the S&P 500 forward this year. You didn't have to pick Nvidia. God bless you if you did, but stock picking is a lot harder than anybody anticipates, and that's why indexing tends to work. You give up any individual gains and the stress and anxiety of trying to pick winners by owning the overall market. And when you have a market capitalization weighted index like the S&P, when tech stock is dominant and it goes up more, it drags the whole index up. So I'm a big AI proponent. I am not a doomster in the AI business. I don't think it's going to destroy all of our jobs any more than any technology has destroyed all our jobs in the past. I remember, go look at some of the history of this. Back in the 1790s, the first mechanical looms that were made in England, there were strikes then because they said the looms are going to destroy our jobs. Well, it did change jobs. It altered manufacturing, but it didn't destroy people's jobs. We created new jobs out of it. So I wouldn't worry about that. I'm also not worried about the Skynet thing, that robots are going to come and kill us. I am certainly worried about more advanced forms of artificial intelligence. But if you look at ChatGPT, it's astonishing how dumb it is sometimes. That is not a sentient machine. That is not a conscious machine. Not even close. But that doesn't mean we shouldn't be concerned about implications of artificial intelligence. I'm just trying to say I'm a backer because it's going to improve productivity. It's going to take stupid, repetitive jobs, tasks, I should say, and automate them just like it's been doing for the last 100 years. And it's going to help improve productivity. And that's what advances the stock market. That's what advances society. Believe me, it's a good thing overall. So I can't pick the winners, but that's why I own the broad stock market.
All right, and Bob, our last question is an interesting one. How much money does someone need to start investing?
Oh, you can, Vanguard, most of the Vanguard accounts are $3,000, but there's many that are $1,000 that you can get started in. And I would say that's, there may even be accounts where you can start with $100. But, most of the mutual funds are in the $1,000 to $3,000 range to start. And the time to do it is just now, anytime. And the biggest mistake, this is in the book that I talked about, was waiting to do something is really a bad plan. This is exactly what happened to me. I did nothing in my 20s, in the 1970s. And I did not actually start saving for retirement in any serious way until I got the job with CNBC in 1990. By then, I was almost 35 years old. That was a long time ago. And believe me, that was a serious mistake because I had to take a lot of risk because getting hired at CNBC, that's a real, that's a crash course in financial literacy, believe me. And I was quite shocked by the numbers and the data. Even if you're saving, $1,000 a year, it makes a difference. Even if you can pull that in, that's a difference because the power of compounding interest is the greatest thing in the universe. It looks terrible in the first few years, but when you start getting out further, a longer tail, 20 years and more, it's amazing. Compounding interest is very simple. You make money on money, and it just keeps compounding. You get $1,000 a year, you make 10%, you have 1,100, 1,000 plus 100. And next year, you're making interest on that 100. And the next year after, you're making interest on the interest you got. You just keep making interest on interest, you see? And it works. And you can do any kind of table on the internet will show you $1,000 at 10% reinvested, compounded over 20 years. Just go on any compound calculator and see. So start early. Don't be, my entire generation screwed up, essentially. Most of us, I'm talking about the baby boomers, that cohort born between 1946 and 1960. Most of us waited too late. And that's why a lot of us aren't very prepared for retirement. A lot of us had to take a lot more risk. And I'm pleased to see a lot of the younger generation are a little better prepared than we were for it. So start now, even if it's $250. There's places you can even start there.
Yeah, I definitely feel like you hear people say a lot, my biggest regret is not starting sooner. So I think that's really good advice for people, Bob.
Yeah, and don't worry about risk. You'd be shocked how little it really matters long term. Oh, it makes me nervous because the stock market might go down. Play historical patterns. On average, the stock market, S&P goes up 10% a year. Now, last year was down 20%, but that was a really weird year and very unusual. Play long term. Think decades. I know it's hard if you're 25 to think what you're going to be like when you're 50, but believe me, it happens. You will get there. You will make it to 50 when you're 25. You will. And you'll be shocked how short the time feels. And if you start now, it's not going to matter if you're down 20% one year. 15 years from now, that down year last year is not going to matter. It won't. It's the compounding that matters in the long term. So don't worry. You can handle more risk than you think you do, unless you think the entire world is going to hell in a handbasket. In which event, good luck. You're going to store canned goods in the basement. Go ahead, but I would bet against that.
Well, thank you so much for answering all of our questions.
Be optimistic.
Yes,
that's the key. Be a glass half full person, not a glass half empty. Generally, things are getting better.
Yes, definitely. I think you and I are both glass half full people. So good reminder to everyone out there watching. And yeah, thank you to everyone for sending in your questions. As always, great questions. And have a happy holiday next week, and we'll talk again soon.
Hey, thank you very much, guys. Everybody have a happy 4th of July. Good questions as always.
Great. Thanks, Bob.